we've seen this, and I'm curious to hear your thoughts too, where we've seen more lenders now, not huge funds, but they're talking about $5 to $10 million funds of their own. And even the institutional investors you and I both know, I'm hearing about a lot of them transitioning their lines to non-mark-to-market lines, so they don't get nailed with these calls. I'm curious what you're hearing out there on the stability side of things.
We've had pretty much the identical conversations you just described and a similar history. So when we started our platform, we first also started purely with the retail syndication concept. And for scale and for various reasons, one of those actually was to create a track record that's large enough to get retail investors comfortable investing with you. So for us, we thought if we build it, they'll come. Who doesn't want to invest in real estate? We're opening up, we're democratizing, we're giving direct access. Everybody's always wanted to invest in real estate. So if you give them the opportunity, they're going to take it. I realized shortly after launching the business that while conceptually that makes sense, when you're building an online business and you're interacting with somebody who does not know you, does not know your company has a limited track record, has limited online visibility because it's a new platform, it's pretty difficult to get the retail investor to trust you, even giving you $1,000 or $5,000.
Yeah.
So we pivoted, and early on, I'd say probably towards the end of 2015, 2016, to taking more of an institutional approach to scale. And the thought process there was, it's more profitable. It gets us to scale and it gets us to volume. But we want to ultimately bring that back to retail. So the strategy was, let's build the marketplace and the track record and our performance history using institutional capital, and then leverage that to bring retail capital back in. So that's what we did. Today, I'd say probably right before COVID-19 hit, about 40% of our capital was coming from the syndication online marketplace concept, and 60% was coming from those whole loan institutional buyers. And as soon as COVID-19 hit, the whole loan institutional buyers were the first ones to have to push pause. Largely, in my opinion, because they were leveraged. You mentioned repo to repo, but just warehouse line leverage in general, as well as reliant on securitizations. And once those two markets stopped, the whole loan institutional market had to stop as well. Whereas the smaller unlevered institutional investor, whether it was a fund or a family office or the retail investor, those that were participating on the marketplace side, they didn't have the same issues. So they've actually continued to deploy through our platform. And honestly, that's one of the things that's kept us afloat during this period of time. That capital has been flowing from those retail investors, and the theory proved itself out. It's definitely stickier. It's diminished nonetheless, just like any other form of capital, but it's stickier. And as far as the institutional world and repo to repo facilities, I think if you look back to 2010, 11, 12, when warehouse line capital was first coming back into the sector, it actually didn't start as repo with mark-to-market features. It was more traditional warehouse lines. And as time progressed and more capital came into the space and more players were looking to participate in this asset class, then it started to shift to this mark-to-market repo structure, which clearly does not fare well in this type of an environment. I think coming out of this, you're going to start to see a huge push back in the opposite direction. Borrowers and asset managers are not going to want to take lines of credit that are structured either as a repo facility or have any sort of mark-to-market feature.